60% of all global reserves are U.S. dollar denominated securities. Could be real estate or stocks, but it's overwhelmingly U.S. government obligations, U.S. Treasury debt in particular. Most central banks and sovereign wealth funds don't get too involved in the stock markets. Some do, but most of them don't. Most of them stick to U.S. Treasuries. That's an enormous advantage for the U.S. because it means our costs of financing are lower, which means our deficits are lower, our economy is stronger. Imagine if we had to finance the U.S. deficits with no foreign buyers. Imagine what that would look like. You know, our interest rates would be a lot higher, our stock market would be lower, our housing would be lower, etc. In addition, when you're not a reserve currency, that means when you are a reserve currency, other people are funding your style of living, so to speak. Just look at the Argentinians, they're not a reserve currency. They want to borrow, no one's going to allow them to issue Argentinian peso bonds. They have to borrow in dollars. So when you're not a reserve currency, you have to borrow in whatever is the reserve currency. So imagine a world where, let's say, the euro or something else was the reserve currency, and we had to borrow in euros. Well, all of a sudden we'd be vulnerable to exchange rate risk, and we'd probably have much higher inflation. By the way, this happened once before in the late 1970s. The dollar was under so much attack and so much stress that Jimmy Carter actually borrowed in Swiss francs. The dollar was so unwanted and so in danger of collapse in the late 1970s that the United States had a great marketplace and we issued Swiss franc bonds, they were called Carter bonds. So, and remember, that was a period of high inflation from 1977 to 1981. Inflation in the United States in those 5 years was 50%, 5-0. The value of the dollar was cut in half in just 5 years. So that's what, you know, when you're in danger of losing your reserve currency status, that's what happens. So it's very valuable to the U.S. Unfortunately, we may be in danger of losing that status again.
What is it that threatens our status as a reserve currency again? Are we going to be back to borrowing in someone else's currency? And why?
Well, you can't rule it out, but I'll give you some very definite reasons why. So I said, you know, over 60% of the reserves are in dollars, which they are. But in 2000, that number was over 70%. So the U.S. role as a reserve currency has dropped from 70% of global reserves to 60% of global reserves in the last 14 years. Imagine if that kept going, and all of a sudden we're 50. 50 is kind of a tipping point. When you're below 50, you're no longer the dominant reserve currency, you see euros and other currencies coming up. So these trends are all, but by the way, they don't necessarily happen overnight. These things take time to play out, sometimes over years, but investors need to look forward. You know, don't just, I call it the curse of the 2-second attention span. People worry about what's happening today or tomorrow. Well, that's fine for a day trader. But if you're an investor, you worry about your retirement, you worry about wealth, your children's well-being, etc. You're already looking a little further down the road. So let me give you some concrete examples of what's happening. One of the big props under the U.S. dollar has been what's called the petrodollar. This is something that came out in the mid-1970s, again, the time when the dollar was under attack. And the United States, through Henry Kissinger, said to the Saudi Arabians, look, we will guarantee your security, the continuation of the rule of the House of Saud and the national security of Saudi Arabia, because they were weak militarily and they had like I said, the Middle East is a bad neighborhood and had a lot of enemies. In exchange, we want you to price oil in dollars. There's no reason why oil has to be priced in dollars. It could be priced in today euros, back then British marks, Swiss francs, Japanese yen, gold. You can price oil a lot of different ways. They agreed to price it in dollars in exchange for our guarantee of their continued rule on their national security. That deal worked beautifully for 30 years, through the 80s, the 90s, the early 2000s. It really did put a floor on the dollar. But just last December 2013, President Obama reneged on the deal. He engaged in a beginning of their time with Iran, which is a bitter enemy of Saudi Arabia. So the U.S. is now saying to Iran, hey, you're our cop on the beat, you're our best friend in the Middle East. And this is a stab in the back to the Saudis. By the way, Saudi sells most of their these days to China, not the United States. So how long will it be before Saudi Arabia says, okay, China, we'll take your currency in exchange for oil, or maybe we'll take gold, or China buys gold and gives us gold, and we'll send you the oil. But one way or another, the dollar is out of the picture. Again, that hasn't happened yet, but that process is already underway. So this is one of many threats to the reserve currency status of the dollar. When that status goes away, as I described, we could be back to a world of borderline hyperinflation in the U.S.
So that's going to bring on inflation and probably also higher borrowing costs for the U.S.
Sure, because we won't be able to borrow in dollars. If we lose our reserve currency status, I mean, the Treasury will still issue debt, but the American people are going to have to buy them. Foreign interest will be reduced. Foreign will say, hey, the U.S., you want to sell bonds, price them in something else. Maybe euros, but maybe this world money, people don't know very much about it. It has a huge name. It's called the Special Drawing Line, or SDR. They're issued by the International Monetary Fund, the IMF. Not very well known, but the easiest way to think about it, the Fed has a printing press that can print dollars. The European Central Bank has a printing press that can print